The IFC can participate in projects with both finance and/or equity. What's the split between the two sources?
It depends on the sector. So within our sector, we're about 30-70 split, so 30% equity, 70% debt. Historically, the institution has come from a project finance, largely debt funding place, but over the last 10 years we've moved quite significantly into the equity space, so we're doing more and more transactions.
Why is that?
There's a number of reasons. The one reason is that a lot of balance sheets of companies or a lot of the risk profiles of companies are not suited for a debt repayment profile. There may be higher risk, maybe a very worthwhile project in a fragile or conflict country of Africa that simply hasn't got the structures in place yet that's going to enable it to attract traditional debt financing. But by putting in equity risk capital, we can fund that project and we can allow it to advance. Clearly, again, putting the private sector finance and development together, we would expect to see a financial return. We would expect the value of our investment to grow.
So how big is the return if you compare it to a company's return?
Our return is reasonably in line with other private equity funds that you see out there. And it comes back to the earlier question that you asked, no donor funding. It has to be competitive funding. So I think we can keep our own with other private equity type investors. This is on the equity side. On the debt side, clearly we have similar returns to financial institutions on the loan book. So no, I think we're quite competitive, and we've had quite a few investments and portfolios where we've done a lot better than the private sector because we're getting into countries that others are not investing in yet. They're riskier. We put a much riskier capital into play. We work closely and get very engaged with the companies to help them grow. So we have pretty good results.